The International Monetary Fund, IMF, and the World Bank are two prominent institutions that play crucial roles in the global economy, yet they serve distinct purposes and function in different ways. Understanding the differences between the two is essential for grasping how international financial systems operate and how they impact countries worldwide. The IMF was established in 1944 primarily to promote international monetary cooperation and facilitate the expansion and balanced growth of international trade. Its main objective is to ensure the stability of the international monetary system, the system of exchange rates and international payments that enables countries to transact with each other. The IMF provides financial assistance to countries facing balance of payments problems, which occur when a country cannot pay for its imports or service its external debt. This assistance often comes in the form of loans, but these loans are typically conditioned on the implementation of specific economic reforms aimed at restoring economic stability and growth. On the other hand, the World Bank, also established in 1944, focuses on long-term economic development and poverty reduction. It comprises two main institutions: the International Bank for Reconstruction and Development, IBRD, and the International Development Association, IDA. The World Bank provides loans and grants to developing countries for projects that are expected to improve their infrastructure, education, health, and economic systems. Unlike the IMF, which addresses short-term financial crises, the World Bank aims to foster sustainable development over the long haul by financing projects that enhance productivity and living standards. One of the key differences between the IMF and the World Bank lies in their funding mechanisms. The IMF is primarily funded by its member countries, who contribute financial resources based on their economic size. This system of quotas determines how much each country can borrow and how much influence it has within the organization. The IMF's resources are pooled together, allowing it to lend to countries in need, often at lower interest rates than they would receive from private lenders. In contrast, the World Bank raises funds through the issuance of bonds in international financial markets. It then lends these funds to developing countries at lower interest rates, often coupled with technical assistance to ensure that projects are implemented effectively. Another significant distinction is the nature of the assistance provided by the two institutions. The IMF typically offers short-term financial support aimed at stabilizing a country's economy. This support often comes with stringent conditions, requiring countries to implement specific economic policies, such as fiscal austerity measures, currency devaluation, or structural reforms. These conditions are intended to restore fiscal discipline and improve the country's economic outlook, but they can also lead to social unrest and increased poverty if not managed carefully. Conversely, the World Bank's projects are generally long-term and focus on development goals. Its funding is often directed towards building infrastructure, such as roads, schools, and hospitals, as well as supporting initiatives in health, agriculture, and environmental sustainability. The World Bank emphasizes the importance of capacity building and institutional strengthening, working closely with governments and local stakeholders to ensure that projects are aligned with the needs of the communities they serve. While the World Bank may also impose conditions on its loans, these are typically less stringent than those of the IMF and are often focused on governance and project implementation rather than immediate economic adjustments. The governance structures of the IMF and the World Bank further highlight their differences. The IMF operates on a weighted voting system where votes are distributed according to the financial contributions of member countries. This means that larger economies, such as the United States and Japan, hold significant influence over decision-making processes. In contrast, the World Bank has a similar voting structure, but it places a stronger emphasis on consensus building and collaboration among its member countries. This can lead to a more inclusive approach to decision-making, particularly in terms of addressing the needs of developing nations. In terms of their target audiences, the IMF primarily serves its member countries, which currently number 190, including both advanced and emerging economies. Its focus is on macroeconomic stability and the management of international monetary systems. The World Bank, however, is more focused on developing countries, particularly those with lower income levels. Its mission is to alleviate poverty and improve living standards, and it often collaborates with non-governmental organizations, NGOs, private sector entities, and other stakeholders to achieve these goals. Moreover, the two institutions have distinct approaches to addressing global economic challenges. The IMF is often viewed as a crisis manager, stepping in to provide support during financial emergencies, such as currency crises or severe economic downturns. It plays a critical role in stabilizing economies and restoring confidence in financial systems. The World Bank, on the other hand, is seen as a development partner, working to build resilience and promote sustainable growth in developing countries. Its focus is on long-term strategies that address the root causes of poverty and inequality. In recent years, both the IMF and the World Bank have faced criticism for their roles in global economic governance. Critics argue that the conditionalities attached to IMF loans can exacerbate social inequalities and undermine democratic processes in borrowing countries. Similarly, some have raised concerns about the effectiveness of World Bank projects, questioning whether they truly benefit the intended populations, or if they sometimes serve the interests of larger corporations and foreign investors. Despite these criticisms, both institutions remain vital players in the global economy. The IMF continues to adapt its approach to better respond to emerging challenges, such as the impacts of climate change and global pandemics, while the World Bank is increasingly focusing on sustainable development and inclusive growth. As the world faces complex and interconnected challenges, the roles of the IMF and the World Bank will likely evolve, but their fundamental differences in purpose, funding, and approach will continue to shape their contributions to international economic stability and development. Understanding these differences is crucial for policymakers, researchers, and citizens alike as they navigate the complexities of the global financial landscape.